Hey there. Ready for a deep dive?
Always.
Awesome. So you sent us this paper, Empirical Asset Pricing via Machine Learning. And
Predicting risk premiums, right?
yeah, the elusive risk premiums, those extra returns you get for holding, well, riskier assets, obviously. It's
Right.
like the holy grail of investing, figuring those out, right?
Absolutely. And this paper and suggesting machine learning could be the key.
Could be a game changer.
Yeah.
So we all know predicting the stock market,
Mm.
it's tough, notoriously difficult.
Oh, yeah.
But what if we could leverage the power of machine learning,
Mm-hmm.
to get a better grip on it?
Mm-hmm.
That's what these researchers, they set out to do.
Right. And they started with a classic approach.
Okay.
Good old OLS regression.
Yeah, the good old OLS.
They used it with just a few well-known predictors,
Okay.
like a company size, its book-to-market ratio, and its momentum.
The basics.
Yeah, exactly.
The tried and true.
The classics, yeah.
But
Well,
then
and
they threw in over 900 predictors.
100 and OLS. It just couldn't handle it.
Too many variables.
Got
Got enough data.
Right.
That's where machine learning comes in.
Ah, okay.
They use techniques like the elastic net.
The elastic net.
Think of it like it's like a filter
Okay.
that helps pick out the truly important factors from that, from that massive pool of 900 predictors.
Right.
So it prevents the model from getting confused
Yeah.
by random noise.
So they're training the computer to kind of sift through all the noise,
Yes,
find the signal.
exactly.
Okay, yeah.
Precisely.
Got it.
And then they took things a step further.
Okay.
They added nonlinear models,
Okay.
like trees and neural networks.
Neural networks.
These models, they can capture these complex interactions between predictors
Right.
that traditional methods, they just miss.
They just can't.
Right. Imagine a
Mhm.
stock size
Okay.
interacting with its past returns
Okay.
and overall market volatility
Yeah. It gets complicated. It gets messy.
really fast.
Yeah.
And these nonlinear models,
Yeah.
they can handle it.
They can handle that messiness.
Yes.
This is where it gets really interesting, for me at least. They found that simpler neural networks
Mm.
with fewer layers actually worked best for this kind of prediction.
It is fascinating, isn't it?
It really is.
Sometimes simpler is better
Yeah.
when it comes to,
Predicting stock return
predicting the market.
makes you wonder, what are the most important predictors? Were they able to pinpoint those?
Well, that's one of the coolest things about this paper. They dug deep
Yeah.
into which predictors were most informative
Okay.
across all these different models.
Across all the models, all right.
Yeah, and some familiar faces popped up,
Right.
momentum,
Right.
how easy it is to buy or sell the stock. We call that liquidity.
Liquidity
And
and
how much the price jumps around, it's volatility.
volatility, right. Okay.
Yeah.
But
They also found that the importance of different predictors,
okay.
it changed
It changed.
depending on the model used.
Wait, so depending on what lens you're using to view the data,
Yeah,
the key drivers, the key factors, those could look different.
absolutely.
Wow, that's pretty significant if you're
Yeah.
trying to build a successful investment strategy, right? Yeah.
Absolutely.
Yeah.
And the impact of these findings, it could be huge,
Huge.
even for the average investor.
Okay.
Imagine you're trying to time the S&P 500.
Okay.
You're deciding when to buy or sell based on,
Market prediction.
market prediction.
Price. Right.
Using a neural network,
Mm-hmm.
you could potentially boost your Sharpe ratio,
Sharp buy ratios.
a way to measure risk-adjusted returns.
Okay.
They found a potential jump from 0.51 to 0.77.
Wow.
Now, a higher Sharpe ratio, that means you're
Yeah.
getting more return for the amount of risk
To the risk you're taking.
you're taking on. Exactly.
Okay, a jump from 0.51 to 0.77, that sounds impressive, but
Yeah.
how realistic is that to actually achieve that in real-world trading?
That's a great question.
Yeah,
Remember, this is based on historical data,
right.
and there's no guarantee.
There's no guarantee it'll work in the future.
Exactly.
Okay.
But it does suggest that machine learning, it could provide
Yeah.
valuable insights
Insights.
into market dynamics.
So maybe it's not a crystal ball, but it could be a pretty powerful
Yeah.
new tool
Cool. In the toolkit.
in the investing toolkit.
Yeah. Okay. So we've talked about these powerful models,
Mm-hmm.
the importance of different predictors, right?
Yes.
But this research also uncovered some fascinating interactions
Oh, yeah.
between those predictors that, maybe aren't so obvious.
Right. For example, they found that the short-term reversal effect,
Short-term reversal, okay.
where a stock that went down last month
Okay.
is more likely to go up this month.
That's most pronounced in the smaller companies.
Interesting. So if you're looking for a quick rebound,
Yeah.
smaller companies might be the place to look.
Well, it's not quite that simple,
Right, of course, of course.
but it does highlight
It,
the importance of considering these interactions.
yeah.
They also found that the low volatility anomaly,
Low volatility.
where stocks that don't fluctuate in price as much,
They're kind of steady.
they're steady.
Yeah.
They tend to have higher returns.
Really?
That's strongest for large companies.
So big, steady companies
Yeah.
might be the way to go for,
If you prefer a smoother ride.
the smoother ride. Yeah, less of a roller coaster.
Exactly.
But, it's not just interactions between, like, stock characteristics.
Right.
What about the bigger economic picture?
You're absolutely right. The paper also highlights
Mm-hmm.
how overall macroeconomic factors, they can play a role.
Okay.
For example, they found that the classic size effect,
Size effect.
okay, where smaller companies generally have higher returns.
Right, right.
It's magnified
Okay.
when overall market valuations are low.
So this whole interaction between size and market valuation it's blowing my mind a little bit.
It's fascinating, right?
Yeah, I never considered that before.
What's fascinating here is how these company-specific traits,
Mm-hmm.
they interact with the bigger economic picture.
The big picture.
This research, it gives us a much more nuanced understanding
Okay.
of how different forces
Yeah.
drive those stock market returns.
Yeah.
Really makes you rethink some of those investing rules of thumb.
Yeah. Yeah.
One of the most exciting aspects of this research
Yeah.
is how it sheds light on market timing.
Market timing.
Remember, market timing is the strategy of,
Yeah.
trying to predict when to be in and out of the market.
Right.
It's notoriously difficult.
It's like trying to predict when lightning's going to strike.
It really is.
But are you saying that machine learning could actually give us an edge here?
Well, the authors,
Okay.
they created a hypothetical market timing strategy
Okay.
based on the predictions of their neural network model
Mm-hmm.
and the results. Pretty amazing.
Okay. How amazing are we talking?
An investor using this strategy to time the S&P 500
Okay.
could potentially have achieved an annualized Sharpe ratio of 0.77
Mm-hmm.
compared to just 0.51
Oh, wow.
for someone who just buys and holds.
Okay. Those are pretty significant gains, but we're talking hypothetical results here.
You're absolutely right.
No guarantees in the real world.
We need to be cautious
Yeah.
about extrapolating these results too broadly.
Right.
It's based on historical data,
Right.
and there's just no way to know for sure
Okay.
how it would play out
In real-time trading.
in real time.
Yeah. Okay.
But it does point to the potential of machine learning
Yeah.
to give us valuable insights
Insights.
into market dynamics.
So maybe it's not a crystal ball, but
Yeah.
it could be a powerful new tool in the investing toolkit.
Exactly. And remember, this isn't just about timing the whole market.
Right.
It also changes how we think about
Yeah.
building portfolios.
Okay.
The researchers,
Mm-hmm.
they actually found that a long-short strategy
Long, short.
based on neural network predictions
Right.
could potentially achieve a Sharpe ratio of 1.35.
Hold on. A Sharpe ratio of 1.35. That's huge.
It is.
Are you saying that machine learning could really shake up the way we, manage portfolios?
It's certainly suggestive.
Wow.
And what's really compelling is that these findings, they aren't limited
Okay.
to any particular type of portfolio.
Right.
The researchers, they tested a whole range of portfolios
Okay.
based on various factors.
Mm-hmm.
And those machine learning models,
Yeah.
especially the nonlinear
The
ones,
nonlinear ones.
they consistently delivered impressive results.
So it wasn't just a fluke. These models, they're picking up on something
Yeah.
that traditional methods, they're missing.
It seems that way.
Yeah. Okay.
One of the things I find most exciting about this research
Okay.
is that it bridges the gap between theory and practice.
Okay. Yeah.
It takes these, cutting-edge machine learning techniques
Right.
and applies them
Yeah.
to a real-world problem that every investor faces.
Right.
How to achieve higher returns without taking on
Too much risk.
too much risk. Exactly.
Yeah. It's not just like an abstract academic exercise.
Uh-huh.
This is research that could potentially change the way people invest.
Absolutely.
Yeah.
And think about the sheer amount of data available to investors these days. I mean, we're truly living in the age of big data
Your data.
and machine learning, it's the perfect tool
Yeah.
for harnessing that data, turning it into
Actionable.
actionable insights.
It's like we've been given a powerful new lens to view the financial world.
Absolutely.
So this could really level the playing field for individual investors
Right.
who might not have the resources
The resources.
of big institutions.
It's one of the most exciting possibilities. But of
Yeah.
course, no research is without its limitations.
Right, of course, of course.
The authors themselves acknowledge
Okay.
that this is just a starting point.
A starting point.
There's still so much more we
Yeah.
can learn about applying machine learning
To asset pricing.
to asset pricing.
Okay, so we're just scratching the surface here.
We are.
What are some of the big questions that still need to be answered?
Well, for one, this study, it focused mainly on U.S. equities.
Oh, okay.
We need more research
Yeah.
to see if these findings hold true
Yeah.
for other asset classes like bonds,
Bonds.
real estate, or for markets in other parts of the world.
Right. It makes sense. What works in one market might not work in another.
Exactly.
Right.
And another limitation is that this study,
Yeah.
it didn't really dig into the why
The why. Okay.
behind those patterns that the machine learning models they uncovered.
Yeah.
They were great at predicting returns.
Okay.
But they didn't explain the economic reasons
Yeah.
for why certain variables were so predictive.
So we can see what's happening,
Right.
but we don't necessarily understand why.
Right. We need to develop economic theories that can explain the pattern
The patterns.
machine learning is revealing.
Yeah.
That's going to require economists,
Oh,
computer scientists,
yeah.
and financial professionals
All working together.
to work together.
It's a real interdisciplinary challenge.
It is.
But if we can combine, the power of machine learning
Yeah.
with the insights of economic theory,
Mm-hmm.
we could truly revolutionize the way we understand and operate
Yeah,
in financial markets.
I completely agree.
Yeah.
This research, it's a call to action
Okay.
for all of us to embrace the possibilities of machine learning
Yeah.
and work together to build a deeper understanding
Of how markets work.
of how markets work.
But let's be real, machine learning can be a complex beast.
It can.
Are there any potential pitfalls we need to be aware of?
That's an important point.
Yeah.
One of the biggest concerns is overfitting,
Overfitting. Okay.
where a model becomes so attuned to the specific data
Right.
it was trained on
Yeah.
that it fails to generalize
Okay.
to new data.
So it's like memorizing the answers to a test
Yes,
instead of actually understanding the material.
exactly.
Got it.
So we need to make sure these models,
Yeah.
they can adapt
Adapt.
to new information
Okay.
and not just repeat what they've already seen.
Right. So it's not just about throwing data at a machine learning algorithm
No.
and hoping for the best.
No, you need to be thoughtful,
Thoughtful.
deliberate in how you build and implement these models.
Okay.
And another challenge is that it can be tough
Yeah.
to interpret
Okay.
the results
Of these models.
of machine learning models.
Yeah.
They can feel like black boxes sometimes.
Black boxes.
You put data in,
Yeah.
you get predictions out,
Mm-hmm.
but it's not always clear why those predictions were made.
Right. That lack of transparency can make some investors hesitant
Absolutely.
to trust these models.
That's why the authors of this paper, they made a real effort
Yeah.
to make their models more transparent.
Transparent. Okay.
They provided detailed explanations
Okay.
of how they work
Yeah.
and what factors
Yeah.
they're using to make predictions.
Mhm.
They also visualized the relationships
Okay.
between different variables,
Right.
which helps us understand,
Yeah.
how the model is thinking.
How the models think it. Yeah.
So it's not about blindly trusting the machine.
No.
It's about understanding how it works and using that understanding
Okay.
to make more informed decisions.
Really highlights the importance of transparency
Mm-hmm.
and explainability in machine learning, especially when it comes to,
Right.
something as important as investing.
Absolutely.
One thing that really struck me in this paper
Yeah.
was how much emphasis they put on features like momentum, liquidity, and volatility.
Yeah, those features were consistently among the most important predictors
Okay.
across all the different models
Like across all the models.
they tested.
Right.
It really underscores their
Yeah.
significance in
Okay.
capturing
Yeah.
the dynamics of the market.
It's almost as if those features are like the secret language of the market.
Yeah.
and these machine learning models are starting to decode it.
I like that analogy. And remember, those features,
Yeah.
they're grounded
Okay.
in fundamental economic principles.
Right.
Take momentum, for instance.
Yeah.
Momentum.
Okay. It reflects the tendency for stocks that have done well recently
Okay.
to keep doing well.
Right.
That could be due to investor behavior, or maybe the market is slowly catching on
Yeah.
to good news about a company.
And liquidity, that just means like how easily you can buy or sell a stock
Exactly.
without impacting the price too much, right?
Right.
So more liquid stock
Yeah.
is going to be like less risky,
Mm-hmm.
which might mean a lower return.
Exactly. And then there's volatility,
Volatile.
which is all about how much
Yeah.
a stock's price jumps around.
Up and down. Yeah.
Higher volatility means more risk, but potentially higher returns.
Higher returns,
If they're like
that
that.
classic risk-reward trade-off.
Exactly.
So it makes sense that, that these features would be so crucial
Mm-hmm.
for predicting returns. They're tapping into like
Yeah.
those fundamental
The
forces
fundamental forces of risk and return.
of risk and return that drive the market.
That drive the market. Okay.
And what's really cool is that these machine learning models,
Yeah.
they can uncover subtle interactions
Okay.
between these features
Yeah.
that traditional models might miss.
They wouldn't see it.
Right. For example,
Hmm.
the paper found that the size effect,
Size effect.
the idea that smaller companies tend to outperform larger ones,
Right. Right.
it's actually stronger
Okay.
when overall market valuations are low.
So it's not enough to just like bet on small companies.
Yeah.
You gotta consider
You have to consider the broader market environment.
that broader market environment.
Precisely.
Yeah. Okay.
And that's where the real power of machine learning comes in.
Okay.
It can tease out
Yeah.
these complex relationships that
Okay.
would be very difficult to spot
Yeah.
using traditional methods.
It's like having a super powered magnifying glass for the market.
That's a great way to put it. And it really underscores the need for,
Yeah.
a deep understanding
There.
of
Yeah.
both machine learning
Yeah.
and financial economics.
So it's not just about like crunching numbers.
Yeah.
It's about understanding
It's about understanding the economic forces at play.
the economic forces. Yeah.
It sounds like an exciting field to be in.
Yeah, especially with all this new research coming out.
It absolutely is.
Yeah.
This research is just, it's the tip of the iceberg.
The tip of the iceberg.
There's still so much more to explore.
And for those of you listening who are ready to roll up their sleeves
Yeah.
and dive in, the authors,
Yeah.
they've made their data and code publicly available.
Yeah, that's great.
So you can actually explore their findings firsthand
Yeah.
and maybe even, build upon their work.
Who knows? Maybe you'll be the one
Yeah.
to make the next big discovery.
It's a fascinating time to be involved in finance.
It is.
And this research really opens up a world of possibilities.
I agree.
So keep learning, keep exploring, and most importantly, keep asking questions.
That's what it's all about.
That's what the deep dive is all about. Thanks for joining us.